$16.15 trillion. That is how much debt American households owed by the second quarter of 2022. A staggering 41.79% increase from $11.39 trillion just 10 years prior.
Now to what could be a debt crisis brewing in our country. Household debt rising to record levels as more Americans struggle to pay the bills. Our chief economics correspondent, Rebecca Jarvis, is back now with more. Good morning again, Rebecca.
Nice to see you again, Robin. And Americans are taking on more debt, $17.5 trillion overall. $1.13 trillion of that is a record amount, and it's on credit cards. Plus, more people are falling behind on their payments.
You're not alone if you have multiple credit card debt, as well as some other loans. I know this can be overwhelming for you. But do you know that about 80% of Americans are in debt? Yes, you heard me. 80% of Americans are swimming in debt. Escaping this trap can be challenging. Moreover, some of these debts are due to high inflation, which has pushed credit card interest rates higher than normal. Though this is a very tough time for many people, there is still hope. With the right strategies, you can become debt-free and avoid drowning in this financial crisis. In this video, I will explain what consumer debts are, the current debt statistics in the U.S., how it affects the U.S. economy in general, causes of the current high consumer debt, and as always, I will lay down the best strategies you can apply to help you stay away or get out of debt. One would ask, what is consumer debt? In simple terms, debt is money owed by one party to another. This can range from credit cards, student loans to mortgages and car payments. When you borrow money, there's usually an interest fee, meaning you repay more than the initial amount. Debt itself isn't inherently bad. It depends on how you use it. For example, a mortgage for a home or student loans for education can be considered good debt because these investments can potentially increase your net worth in the long run. However, debt for unnecessary expenses can quickly spiral out of control and become bad debt. This is why many financial experts are concerned about rising consumer debt. With a significant portion of the U.S. economy relies on consumer spending, a widespread credit issue impacting lower and middle-class families could have devastating consequences. Let's look at the current U.S. consumer debt statistics. In a recent Federal Reserve Bank of New York Center for Microeconomic Data report, total household debt in the U.S. increased slightly by $16 billion to reach $17.06 trillion in the second quarter of 2023. In quarter four of 2023, consumers took on a record $1.13 trillion in credit card debt, a 10% jump from a year ago. However, a closer look reveals a more nuanced picture. The credit card debt surge, reaching a record high of $1.13 trillion, reflects a significant 4.6% increase from the previous quarter. This jump coincides with increased credit card accounts and total credit limits available. On the other hand, mortgage debt came to $12.14 trillion as of quarter three of 2023, an increase of $126 billion over the previous quarter. According to data from Experian, average mortgage debt has steadily increased yearly, reaching a new high of $241,815 by quarter four of 2023. According to Experian data, the average auto loan balance held by consumers in the United States increased 5.2% to $23,792 in quarter three of 2023, increasing the total auto debt owed by drivers to $1.51 trillion on cars, motorcycles, and other personal vehicles as of the third quarter of 2023. Higher loan values can explain this increase in a lower overall volume of new loans than pre-pandemic levels. Interestingly, student loan balances bucked the trend, decreasing by $35 billion to $1.727 trillion in quarter three of 2023. This decline is likely due to the federal student loan repayment pause that was in effect until August 2023. Overall, delinquency rates remained low across all debt categories. However, there were slight increases in transition rates for credit cards and auto loans, suggesting a potential for future delinquencies. Credit card performance significantly declined compared to other debt types, highlighting a potential concern. On the other hand, student loan performance continues to benefit from historically low delinquency rates due to the recent repayment pause. how does higher consumer debt affect U.S. citizens and the economy as a whole? We have gone through the statistics, but how does it all reflect on you and the economy as a whole?
60% of American adults surveyed cited their level of debt as their main reason for financial anxiety.
Debt is rising every single day, and it is something that I can say is debilitating.
Now, when looking at the impacts it has on U.S. citizens, the first thing that pops up is the financial strain on the citizens. You can work hard for years and earn a lot, but much of your paycheck disappears into debt payments. This is the reality for many Americans struggling with high-interest loans, credit cards, and other debts. This can lead to stress, anxiety, and even sleepless nights.
For me, even with a master's degree and having experience out in the field for over 10 years, I've had to have at least 3 jobs in order to not live paycheck to paycheck.
Consumer debts also limit your opportunities. It also limits your financial future. Buying a house, investing in your education, or even starting a business might seem out of reach. Sometimes, people are forced to stay in high-paying but stressful jobs to keep up with debt repayments.
The income spectrum, the lower end of the credit score spectrum, we find that borrowers have a very hard time accessing traditional credit, like credit cards or a mortgage loan. And the credit that they do have available can be at higher interest rates and more costly.
It's important to recognize that the weight of debt isn't evenly distributed. Lower-income communities and people of color are often disproportionately affected. Predatory lending practices and lack of access to fair credit options can trap them in a cycle of debt. Now, let's look at the national scale. When a large portion of Americans' income goes towards debt payments, there's less money left for spending on everyday items. This can hurt businesses, slow economic growth, and weaken consumer confidence.
For the American economy, household debt acts as a double-edged sword. On one hand, it boosts consumer spending, which contributes almost 70% of the total United States GDP.
Debt can indeed fuel economic growth by allowing people to spend more. However, this is a double-edged sword. Unsustainable debt levels can lead to economic bubbles and eventually recessions. A population drowning in debt is more vulnerable to economic downturns. Job losses or unexpected expenses can lead to loan defaults, impacting the entire financial system. Causes of higher consumer debt. America's household debt continues to climb, surpassing $17.3 trillion in the second quarter of 2023, according to the Federal Reserve Bank of New York. Of the $17.3 trillion debt, over $9 trillion is from mortgages, and around $1.3 trillion comes from car loans with low interest rates since 2008. This concerning trend can be attributed to several key factors. Firstly, easy access to credit has fueled debt accumulation. Financial deregulation and aggressive lending practices have made credit cards, lines of credit, and loans readily available. This convenience, however, can lead to overborrowing, especially with enticing marketing tactics targeting consumers. Secondly, stagnant wages and rising living costs create a financial squeeze for many households. A 2023 report highlights that since 1980, median household income has grown by a mere 1%, while housing costs have skyrocketed by 118%. This stark disparity forces individuals to rely on credit to maintain their standard of living, impacting their ability to save and potentially leading to a cycle of debt. The high cost of education is another significant contributor. Student loan debt has reached a record-breaking $1.48 trillion, averaging $35,000 per borrower. This burden hinders household finances by limiting savings and potentially leading to increased reliance on other forms of debt to manage daily expenses. Credit card debt also plays a role, with the average consumer carrying approximately $6,000 across 4 cards. Economic downturns further exacerbate the issue. The post-pandemic recovery has witnessed supply chain disruptions and inflation reminiscent of the late 1970s. These factors, coupled with the ongoing pandemic, have pushed up the cost of goods, making it even harder for households to manage existing debt alongside rising expenses. Beyond these systemic factors, individual financial habits can also play a part. Impulse purchases, keeping up with appearances, and poor budgeting contribute to debt accumulation. Easy access to credit and aggressive marketing can lead to impulsive spending beyond one's means. In some cases, predatory lending practices with high interest rates, hidden fees, or aggressive terms can further complicate the situation, making debt repayment even more challenging. The overall picture is concerning, with debt levels rising across nearly every category compared to 2020. This trend highlights the need for a multi-pronged approach, encompassing financial education, responsible lending practices, and addressing income inequality to ensure a more sustainable future for American household debt. Solutions and tips for managing. Let's assume you have some debts or are looking for ways to manage these debts and not acquire more. Well, I have a list of strategies you could apply to keep up with your debt problems and help you even repay them. One of the simplest yet most effective strategies for managing debt is to pay your bills as soon as they arrive. This reduces the risk of forgetting a payment and incurring late fees or interest charges. Another one is to prioritize your debt payments. Not all debts are created equal. Different debts come with different interest rates and consequences for non-payment. Therefore, it's important to prioritize your debts to manage them effectively. Typically, it's advisable to prioritize high-interest debts as they cost more over time. This is known as the avalanche method of debt repayment, where you pay off debts with the highest interest rates first while making minimum payments on others. The next strategy you need in your arsenal is always making the minimum payment to avoid fees. Regardless of your debt repayment strategy, always make at least the minimum payment on all your debts each month. Failure to do so can result in late fees, increased interest rates, and negatively impact your credit score. Even if you can't pay off a debt in full, making the minimum payment shows lenders that you're committed to meeting your financial obligations. Remember, the minimum payment is just that, the minimum. While making only the minimum payment will keep your account in good standing, it won't do much to reduce the principal debt. The next and most important strategy is to create an overview of everything you owe. Before effectively managing your debt, it's important to understand your financial obligations clearly. Start by creating an overview of everything you owe. This includes listing all your debts, such as credit card balances, student loans, mortgages, car loans, and other outstanding loans. Note each debt's outstanding balance, interest rate, minimum payment, and due date. This comprehensive overview will provide a snapshot of your financial situation and help you prioritize your debt repayment efforts. Next on our list of strategies is to create an emergency fund to avoid unnecessary debt. Building an emergency fund is an essential step in managing debt. Life is full of unexpected expenses, such as medical bills, car repairs, or sudden job loss. Without an emergency fund, you may be forced to rely on credit cards or loans to cover these expenses, leading to additional debt. Strive to save 3 to 6 months' living expenses in an easily accessible emergency fund. Start by setting aside a small portion of your monthly income and gradually increase your savings over time. The last strategy here is to pay what you can afford. When managing your debt, paying what you can afford is crucial rather than just the minimum payments. While minimum payments keep your accounts in good standing, they often only cover the interest charges, leaving the principal balance untouched. Don't let debt drag you down any further. Hit that like button and subscribe for more personal finance tips. In the comments below, share your best debt managing strategies with me. And remember, financial freedom is within reach. Take control of your money. Take control of your future. That's all I have for you today. See you on the next one.